Hello and welcome. Hey, everybody. I hope you're having a fantastic day so far. My name is Laura Bolio. I am the VP of Marketing here at Holistiplan, and I'll be co-hosting with Debbie Taylor here today. So if this is your first time at a Holistiplan webinar, you are in for a very, very special treat. If you've been with us before, welcome back. As always, our goal is to bring you the maximum value possible. Today, we're talking all about minimizing your clients' biggest tax liabilities, particularly in retirement, with none other than Debbie Taylor herself. It's my great pleasure to introduce to you my dear friend Debbie Taylor, or as we call her here at Holistiplan, Queen Debbie. Debbie is the founder, wealth advisor, and lead tax planner at Taylor Financial Group, which is a full-service woman-owned wealth management firm. She's also a very highly sought-after industry speaker, and she leads our Holistiplan Masterclass, where hundreds of folks tune in each month to unlock the secrets to tax planning success. We also have Jen here on her team. Jen is a paraplanner. And before we kick it off, yes, this session will be recorded. Yep, we will send out the slides, we'll send out the handouts, that will all be emailed after the webinar. If you have any questions, please drop them in the Q&A. We will do our best to answer them as we go. And anything that's not answered, we'll send out in a follow-up email. But please feel free to engage, ask all the questions you have. And with that, Debbie, I would love to hand it off to you.
That's great. Thank you, Laura, for the kind words and the great introduction. And I'm going to tell you, Laura, this is absolutely nuts because we have over 500 people that are here live. Okay.
Pretty incredible.
So that is crazy. I don't know if it's because Hurricane Debbie. Have you heard about Hurricane Debbie?
I've been hearing all about Hurricane Debbie.
I'm getting a lot of people giving me a tough time about Hurricane Debbie working its way up the coast. And so maybe a lot of people are indoors because of Hurricane Debbie, and they're like, hey, instead of watching Ferris Bueller's Day Off, we are going to tune into Holistiplan. But that's great. That's great. So we are over 500 people, and that's pretty cool. We're close to 600 now. All right, so let's hop in. So thank you, Laura. A few public service announcements, and then we're going to get into the meat of today. So first of all, I wanted to do a shout out to Cap South, which had a webinar earlier this week that I sat in on. And I just thought it was really beautiful how they handled a lot of the things that we're talking about here on our monthly webinars. And so one of the things we've tried to communicate is the service calendar, your unique value proposition, right? All of that is for you and your firm and your clients, and it's got to make sense for you, and it's very iterative. And so what I'm doing today, by the way, is different than what I did 6 months ago. And I can tell you right now, we're already making changes for 3 months from now and 6 months from now. And so this is constantly evolving for everybody. And what I loved about Cap South is they were sort of right out there talking about how, what they scaled up, what they scaled down, what made sense for them, what they're working on, where they succeeded, where they might not have succeeded, and brava to those ladies. So highly recommend if people want to sit in on another webinar because you can't get enough of us at Holistiplan, that you tap into that one. So that was great. So that's number one. Number two, if you still, by the way, we're over 600. And by the way, people who are on, you need to stay on to the very end because I have bonus content at the very end that was not advertised. You see this title? There's stuff that I'm doing that's not advertised. It's going to be very valuable. Okay, number two, if you can't get enough of us, then we're going to be at Nitrogen doing a pre-conference for, I think, 3.5 hours. And so Holistiplan's doing a whole pre-conference. The founder's going to be there. Laura's going to be there. The team's going to be there. They have a booth. They have like a room where you can sit and do demos. And I am bringing a number of members from my team who've worked with me for several years. And we're going to work together to help all of you, support you on your mission. So think about that. Nitrogen, I still call it Riskalyze. It is in Nashville. I can't think of a cooler city in the world. And so that's something to think about. And that's in October. The third thing I want to mention, what's that?
And it's also free. The tax planning journey is also free. So
Love
it's a free hour event. So if you're in Nashville, you should absolutely stop by. We'll drop all the information in our follow-up email so that you can get all the info there. But yeah, definitely consider it. It should be a really good time.
Yeah, no, and I mean, Riskalyze/Nitrogen does good conferences, and it will be even better with Holistiplan doing 3.5 hours. So that's exciting. The third thing I wanted to mention, public service announcement, is that our next subscriber session is September 19th, and it is going to be an open forum, okay? And what I mean by open forum is Laura and I literally spend hours every month debating, discussing what you want to hear, okay? So I am an open book. I'm here. I will bring 25 years of my playbook to you. You all know that, okay? Laura is all about making you happy, having you come back, keeping you sort of engaged with Holistiplan and using it as much as possible for as many clients as possible. And so this is a big topic of conversation Laura and I have, is what you folks want to hear, what format you want to hear it in. So we just decided, hey, why don't we have September be an open forum where you bring your questions and we're going to answer them. So I'm putting that out there. We have over 600 people on today. So if there are questions that you want us answering, there are topics that you want us presenting in the last couple months of the year, then please drop it into the chat today, drop it into the Q&A. I read them all. Laura's reading them all. We have 2 members from the Holistiplan team that are on right now, Emily and Carrie. And I get these afterwards and I go through all of them, but Laura certainly will. So if there are things you're like, oh, I wish they would cover this. Oh, I wish they would cover that. Whatever it is, you put it in there because we're more than happy to do that. And the ones that get like thumbed up, those are the ones obviously that we're going to address, create presentations around, also even going into next year, if Laura will still have me, ha ha ha. And so anyway, so if you put that in there for now, and then that will help us either create future presentations for the rest of the year and next year, and also for September, addressing your questions. Now feel free September 19th to hop on with questions on the spot, no problem. I'm going to have a number of my team members who've worked with me for several years who look at this from all different angles. So, you know, I have Jared. Some of you remember Jared from earlier this year and last year. He's the one who actually like physically gets the tax returns, uploads them to a Holistiplan, does the tax report, right? So like he handles that part. Jen with me today handles the advanced Roth conversion work. With my daughter, Caroline. Caroline will be at Riskalyze in Tennessee. Jared will also be there. And so we have taken this work and split it up among various team members. They're all going to be on next week, next month. And again, like I said, a lot of them will be at Nitrogen with us. So any questions you have that you want to sort of get us addressing, drop into this Q&A today. And please come September 19th and let's have like a great open forum and make Holistiplan and your practices as good as possible. And then with that, I want to introduce Jen. Many of you know her. She's worked with me almost 5 years and does a lot of the advanced planning with me. And so, like I said, Jared will handle like the tax return intake, uploading it, doing the tax report, chasing down tax returns from clients, which is, you know, a whole process in and of itself. All these things we've talked about in previous sessions. Again, happy to revisit them for those of you who are new to Holistiplan. So that's Jared's area. Jen's area is doing the advanced work with me, really is Jen's area. And so that's more of what we're hopping into today. And so then without further ado, we are going to continue. So what are we talking about? We're going to talk about minimizing liabilities through life's 6 stages. Now, we had to pick 6 stages. Some of them are obvious, right? Like, oh, everybody is born and, you know, everybody dies, right? But some of the stages in between might not apply to everybody. So there's my disclaimer, right? Not everybody gets married, right? Not everybody gets divorced. But we had to sort of pick some milestones and use that as a way to demonstrate the software, right? So there's my disclaimer. Here is some bonus material that was not advertised, and this is, or not advertised the whole time, right? Is we know the IRS came out with guidance on July 18th about how to handle those inherited IRAs. And of course, we've been waiting for this guidance for years. And so it came out on July 18th. So, you know, 3 weeks ago. Obviously, there's been articles in the press on it, but I wrote an article on it for Horse's Mouth. And at the end today, we have bonus content sort of walking you through what that guidance means for you and your clients, and also some ways to set things up so that you can do the analysis for your clients for going forward with those inherited IRAs. And then tied into the inherited IRAs is that postmortem tax planning, which is what we call it, and technically what it is. And so that's at the very end today. And again, bonus material. because when we put all this together, we didn't know that the IRS was going to come out with their guidance. I mean, we knew it was coming eventually. All right, minimizing tax liability through 6 stages. And first question, do tax liabilities change throughout life stages? And we're going to say yes. So I'm going to skip this poll because I know here we've got 700 people on today, and I know that you all know that, right? You all know that. So we're going to keep going here. All right, without further ado, here are the 6 stages that we picked. Now, I know there's some missing, like single is missing, but I felt as if single could be incorporated in divorce, and in widow, right? Because you're single when you're divorced, right?
Yeah.
Right. And yes, there are different filing statuses technically there that are available, and we're going to address those as well. So, we want you to take sort of a broader view to this, right? But here are the 6 stages that we use, okay? And again, for teaching purposes. All right, so we're going to start. So here's the format for today, is we're going to go through 2 stages where you're hearing me talk and go through some of the tax law part of it, right? And then Jen is going to demo some of that in the software. And so again, I'm going to go through 2 stages, and then Jen is going to demo. That's how we're going to do it. And to be clear, prepping for today was interesting to me because, this is where I think this is where the benefits of software can possibly, how do I say, create at times a sense of complacency, which is why you're all on here today. And my point is that anyone can go and put a number into software, right? Like anybody can do that. Like my cat could walk across the keyboard and like have numbers in the software. But it does take the additional training, the additional education that Holistiplan is so dedicated to, right? It does take a little bit of that to be thoughtful in how you approach some of these things, particularly when we're going through the different stages. And so it was interesting preparing for today because honestly, I had to bone up on some of these tax rules. I sent Jen out to do some additional research, some things that we're not seeing as much or whatever. And so again, I think it's smart that you're on here today because on some level, this feels like a pedestrian topic where you're like, yeah, Debbie, people married, people divorced, like eye roll. And I get that. But on another level, each of these stages has different tax rules that you do want to be familiar or reminded of so that when your client is going through it, you'll know some of those pressure points. You might be able to offer some guidance. And so it was just sort of interesting. Something that seemed so simple actually became a little bit more nuanced as we were going through it. All right, so let's talk about the married couple. Okay, so Jen put together this deck for me, right? And she says, marriage is a joyous occasion. Yes, Jen, yes. Okay, I full-heartedly agree with that, Jen, okay? We're gonna move on. All right, so some of the nuances, right? Marriage penalty or bonus. We had a lot of fun with this one, right? It's going through the list of marriage penalty items, marriage bonus items, and then marriage neutral, right? Marriage neutral. And so we're going to talk about some of those. And of course, that can affect the tax credits and the deductions, and even the home sale exclusion, which, by the way, your clients continue to get that wrong, right? How many clients come to you and they still think it's that same home sale exclusion rule, literally from like 30 or 40 years ago? And I'm like, that rule has not been around for like 30 years, right? Oh, if I like roll the proceeds into it. No, I'm like, what are you talking about, right? So the home sale rule, even, there is a bit of a marriage penalty on that because you both needed to have owned the home for 2 of the 5 years. So if your spouse is not part of that 2 of the 5 years, that could possibly disqualify you from the home sale exclusion, right? So it's like all these little nitpicky things that, again, even I have to look up. Another example is we had a client who was newly widowed. She's living in the house, and she's like, hey, I want to sell the house. Do I still get access to that 500,000, or does it drop to the 250? And if she sells the house within 2 years of being widowed, then she gets the $500,000 exclusion. If she goes beyond this 2 years, then she's down to that single exclusion, which is 250. So is it a marriage penalty per se? No, because it's 250 single, 500 married filing joint. But there are, again, some nuances, some tricky rules around this. that would be good for you to know. And of course, when you're guiding clients, that was really important information. The other thing that's interesting about the home sale exclusion of 500,000 is really up until a year or two ago, it was basically not applicable because people bought a lot in 2017 or around then. That was a high for the market. And it really took, 8 years, 7 years, whatever, for the market to get back to that. So for years, we have not had to deal with that home sale exclusion. But now I could see the home sale exclusion becoming an issue again when clients start moving. And of course, they haven't moved a lot in the last year because mortgage rates are so high, so people don't want to leave. But interestingly enough, mortgage rates hit a low today. I think it was like a 13-month low. And so there's probably some hope in the next year or so. Interest rates go down a little bit. We still have those high home values. You're going to need to refamiliarize yourself with that home sale exclusion that was essentially irrelevant, almost for the past decade. So again, like this is sort of interesting also when you've been at this a long time, is things that you used to do, you're not doing anymore because they don't make sense because of the market. And then you're back doing them again. Same thing as aside with estate planning is 20 years ago, everybody got an ILIT. You were doing, A/B trust, right? Family trust. You were doing QPERTs, right? Then, for 15 years or so, that made no sense because our lifetime exclusion, was so high and then eventually got doubled as a result of TCJA. If the Democrats get in power and if they have their way, it's not a political comment, then, some of those estate planning strategies might be brought back to the table if that lifetime exclusion gets cut. And so it's sort of interesting. Things sort of just keep recycling and recycling. Okay, so that's married couple. Let's talk about, yes.
Just quickly, could you switch your view to presentation mode? We're getting a couple of comments that they would like to see the screen a little bit bigger.
All right, how about this? Is this good?
That we can still see both of the slides. I think you want to do presenter view.
Okay.
There, that's perfect. Thank you.
Okay. Just click next. Yep. Okay. Sorry about that. Okay. So this is all right. So this is the married couple. So I made a note of a few things. First of all, there is a marriage penalty, not only a federal concern, but 15 states have some form of a marriage penalty, baked into their tax code, right? 15 states, including New Jersey, New York, California. So some big states. So again, remember, it's not just federal that we have to worry about. It's also New Jersey. New Jersey, listen to me. I'm from New Jersey. It's also the state. And again, this is where Holistic Plan can be very helpful because it does have the state observations. Okay, so let's talk about then where the marriage penalty creeps in, just as a reminder. So the NIT, right? The net investment income tax. It is $200,000 for single, $250,000 for married filing joint, right? That's a marriage penalty. Where else do we see it? Capital loss. So you can deduct $3,000 whether you're single or whether you're married, right? By the way, that $3,000 capital loss carry forward has not been adjusted for decades, right? That's why it's so small, $3,000. And so that's also a form of a marriage penalty. Itemized deductions, right? If you're married and one of you has large itemized deductions, the other person is sort of pulled into that, obviously then can't claim a standard deduction. So part of being a married couple is you're sort of both along for the ride together. And yes, technically you can do married filing separately, but those of you who run that analysis know that literally 98% of the time it makes sense to do married filing jointly, right? It's this myth that clients think, oh, married filing separately can make sense. It is very rare, and it's only extreme situations where someone with very, 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 very low income has very, 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 very high deductions. That's what you need. That's where married filing separately makes sense for the most part. There's one or two examples, but again, they're truly outliers. And by the way, Holistic Plan can run that analysis, right? You just go up and change the filing status. And just as an aside, I had a client come to me. She asked her accountant to run that analysis, and he charged $350. And I explained to her, do you realize he charged $350 to hit a toggle on his software, literally a toggle. So just again, the value of what you're offering with Holistiplan, CPAs are charging $350 for that, right? And then the SALT deduction, which we all know is very highly politicized. That's $10,000. It is not adjusted for inflation, and it's $10,000 whether you're single or married. And then, like we talked about, the home sale exclusion is both spouses need to meet the use test, right? Because you have to use the house as a principal residence for 2 of the last 5 years. It doesn't have to be the last 2 years, it just has to be 2 of the last 5 years. But both spouses have to meet that use test to qualify for that full $500,000 exclusion. And so those are some examples of the marriage penalty. And then, of course, I'd be remiss if I didn't mention sort of almost the biggest and possibly the most obvious marriage penalty of all, and that is when you're in the highest tax bracket. And so if you look at your tax bracket sheet, and all of you should have something like this. So this one's actually from Horse's Mouth, and I literally have it everywhere I go. So if you're serious about taxes, which I know that you are because you are dialing in on an August day, and by the way, there's 700 of you, which is nuts, 700 of you, okay? Then you need to have this with you everywhere you go. So I carry it with me. It's in my home study, which is where we are right now. It's in my desk drawer here. It's in my desk drawer at the office. I keep it in my conference room. I do not walk into a meeting without this, okay? And there's different versions. You can go online and grab some, but this is one for Horse's Mouth I helped to draft. Anyway, if you're in the highest tax bracket, what you notice when you look at the tax bracket, single versus married filing joint, is that the tax brackets for married filing joint are basically double the single tax bracket. So that's not a penalty, that's not a bonus, that's just neutral in my view. But when you get to the highest tax bracket, it's no longer doubled, right? And so anyway, that is then a marriage penalty for those higher earning couples. And Jen is going to demonstrate that once we talk about the next slide or two, once we go through these. Okay. So getting married checklist. So this is from FP Pathfinders, and the checklist covers 29 of important planning issues, right? Tax planning, insurance, asset debt, of course, estate planning, beneficiaries. And so this is a nice summary for you to look at. Now, if you're like, hey, like I could just use AI. AI is not there yet, okay? Let's be honest about it. AI is not there yet. It gets you maybe 80%, 60%, 70%, but 80% is not good enough, right? So you still need to be smart. You still need to think through these things. So just sort of a little reminder there. And we love AI, don't get me wrong. All right, divorced client. So think about it this way. A marriage ends in one of 2 ways. It ends in death or divorce. What do you think about that, Jen?
Can't avoid it.
I love Jen. She's very practical. She's very practical, right? You can't avoid it, right? Okay, so let's talk about the divorced client. We're going to get into the death in a little while, right? And so a couple things to think about, right, is we have property division, yes, and we have retirement accounts divided up with quadros. We all know about that. So what are some other things to be thinking about that are a little bit more nuanced? Is the filing status, right? So what inevitably comes up, and I'm not looking at the chat right now, we will in a little while, but what inevitably comes up is like, oh, I don't have to file single, I could file head of household, or I don't have to file single, I could file as a widow, right? When, down the road. But again, not that easy. And this comes up, literally every chat, this comes up, where I'll start talking about a widow filing single, and then having to do Roth conversions as a single, and the chat inevitably is like, oh, can't they file widow, right? And I'm like, no, it's not that easy. So let's do a little bit of review here for you, just a little bit of reminder. Head of household, to qualify, you need to be unmarried, okay? And you need to have a dependent in the home, right? You need to have a dependent in the home. So that's head of household at its most basic. So if you are unmarried, right, you basically got divorced, and you have the head of, you have the dependent in your house, what is nice about head of household is it increases the standard deduction and it has more generous tax rates. And how to think about it is head of household is in between single and married filing joint, okay? So in our perfect world, we'd be married filing joint because that is the most tax advantaged way to file, right? Single is probably one of the worst, although probably married filing separately is even worse than that because the government does not want you married filing separately, right? So put that aside for a second, right? Single is here, married filing joint is here, head of household is right in the middle, okay? So your standard deduction, right in the middle, and the way they work, the tax brackets is right in the middle. So definitely a nice bump if you could work out head of household, but like I said, you need to have a dependent in the home. The dependent does not need to be your child. It could technically be a parent, but you need to have the dependent. You need to be supporting the home more than half the cost of the home, okay? And of course, you need to be filing a separate return from your spouse. That's a whole unmarried part, right? And so that's the idea behind this. And like I said, it can be a qualifying child or a relative. It could be a parent, right? It could be somebody like that, but they've got to be qualifying. Okay, so that's head of household, and it's very nice when you can get it. All right, so looking at this, just a reminder for all of you, because we have 700 geniuses on the call today, right? But just a reminder then, filing status we talked about, alimony. Remember, alimony is or is not deductible, is or is not taxable as a result of TCJA of 2018, okay? So here's the date. If it is a divorce finalized before 2019, then alimony is deductible and the recipient has to pay taxes on it, okay? If it is after 2019 or after 2018, then there's no tax treatment, right? There's no tax treatment. You're not getting the deduction if you're paying it, and you're not paying taxes if you're the recipient. What did this do? Well, predictably, right? Because the tax code is incentives, right? The tax code is a bunch of incentives. They may seem chaotic and not well organized, but their incentives is what I'm seeing, at least in New Jersey, and just makes sense now, is some of these alimony payments have been decreased by about a third, okay, these settlements. Why? That's just math. If I'm paying $100,000 a year in alimony and I get to deduct that, then that really is only costing me, well, I mean, you don't want to hear about my tax bracket right now, but that's really costing the normal person $60,000 or $70,000, right? Well, if I'm not getting that deduction, then I'm not going to pay out 100. I'm going to pay out, that sort of tax equivalent, like what that after-tax value is essentially, and that's going to be more like $60,000 or $70,000. And so that was sort of an interesting wrinkle. You could see that coming. That's just math. And so it could make then other types of settlements more attractive, right? So maybe you get more in child support. Maybe you take the lump sum, right? Now there's more things in play because some of those tax incentives and tax punishments have essentially been removed. So that's sort of interesting, and we're still seeing that sort of work its way through. Child support is tax neutral, right? Dependent, that's a big sticky area. Sometimes you see them alternating, right? Again, up for negotiation, and the tax credits and deductions. And so one thing I wanted to mention about this with the divorcee clients is there was another note, and now I got to just check my notes on this. So I'm going to move forward. I'm going to come back to that. I wanted to show you then a divorcee client analysis email that we put together. And so this was for a client heading into a mediation who needed some counseling. This is what we put together. We literally put it together over like 3 business days. This was a great product, I believe. Jen helped me. And we were able to charge what, $3,000, $3,500 for this? Yeah, which the client quickly paid. So just something to think about in the back of your mind. And of course, Holistic Plan was a big help with this. And this here are the topics that were covered in that email that we just sent. So I wanted you to just see how the topics broke out. And one of the things that I wanted to mention as we go through them is we talked about alimony and child support. And now again, some things that had been done years ago because of the tax incentives are now being adjusted, right? Dividing assets and liabilities, always looking at the after-tax value of that, right? So leaving somebody with high taxable income and leaving them an IRA, right, through a quadro, right, that's not going to be so great for that person. The lawyers are not so great in this area, or they're very uneven. And this is, again, where you can come in helping to run some of this tax analysis. Plan needed for housing, health insurance. So remember, COBRA is available up for 36 months if there's a divorce, 36 months. So that's important to know. And then the one thing I did want to mention is the children with college and the agreements. So too often I see people coming to me who got divorced and did not address college funding, who's paying for what. I don't know if it's because the kids were younger, it gets too complicated, the judges don't want to deal with it, but they kick the can down the road. And I don't understand how that happens, because college expenses are literally one of the largest expenses that any parent can face. So how do you not address that when you have the lawyers in the room and when you're hammering this all out? But often it is not, or it's addressed in a very perfunctory way. And so one of the things I want to encourage you is that if you have clients in this type of situation, make sure that college funding is addressed, because really the kid suffers, right? The child suffers if we don't think this through. Or honestly, the more compassionate parent suffers, who could be your client. Did the marriage last 10 years? And that's important, because if we've got 10 years under our belt and we have not remarried, and I'm going to assume the husband is collecting, let's say he's the higher earner, and she is 62 years old, then we're able to collect on his record, all right? And so again, a number of planning items coming in, through the divorce. Okay, with that then, I am going to have Jen take over and start doing some demoing of this.
Okay, so we're gonna hop into our handy scenario analysis in Holistiplan. So we're gonna be looking at the Smiths today. As you know, I'm just showing you, go into the dashboard, and then we just go to the scenario analysis, which I, of course, built out some of these already. So we're going to talk about some of the items Debbie highlighted on in terms of the marriage bonus, the marriage penalty, and then, of course, going from married to single if the client gets divorced, and some of those key items to be looking at. So first, I pulled up here the married filing joint versus single scenario, and the marriage bonus we'll highlight on first. So really, with those middle income type of clients, you're most likely going to benefit from going from single to married filing joint. As Debbie said, it really only kicks in at that highest tax bracket. So here you'll see the two single clients. So assuming this is client one, they have, the higher income here of over 400,000. Client two has slightly lower income of 80,000. Some minor other income from investments here, some long-term gains, can input that there. Any other income can be inputted in this section. And then, of course, you see here the standard deductions for single, half of the married filing joint, which we'll get to, so they each get that lower deduction. And based off of their single situations, you see client one was in the 35% tax bracket, client two in the 22%. So obviously different situations, but when they come together, they get that combined income of 500,000, which is of course higher than client one's 420, but you see that the tax bracket or marginal bracket goes to 32%, whereas that one single client was already in the 35 with that high income. So this is a big bonus here. And then of course, as I stated, they get double the deduction. So that's great to point out here. And then we will look at now, so those are just some of the benefits of married filing joint, so the bonus. So now we'll look at penalties. So let me just switch out some of these scenarios. This is also just another great feature of Holistiplan to touch on. You can move all these scenarios to the bank and just pull them back up and switch around. So this is just another nice thing to look at and really worked for showing this demo. So now I'll pull up the marriage penalty situation. So same idea here, two single clients and then married. And as we discussed, The marriage penalty really comes in that highest bracket because from single to married filing joint, it's not doubled. You're already in the 37% tax bracket with about $610,000 of income for single. And then for married filing joint, it's only about $730,000. So not double, not even close to being double. So say you have these two really high income clients, each making $600,000 a year. Same situation as before, minor, small other income from investments, so some small gains here. And then when we go to the bottom, you'll see tax bill, and they're both in the 35% tax bracket. So in this case, they're both filing single and you see their tax bill. But if they're married filing joint, you see their income combined is 1.2 million. Everything else stays relatively the same. They get that higher deduction, but because of those tax brackets, you'll see they're actually into the 37% tax bracket. So this is really where the marriage penalty kicks in here. If you just quickly combine these two tax bills for the singles, it'd be about 360. So they're actually saving some on taxes, of course, because they're in the lower brackets. And then you see 370 about for the married. So those are just some of the penalties to point out. And then, as Debbie discussed, there's some other things to be aware of. So if we go to the itemized deductions, you see the SALT tax, obviously 10,000 max if you're single or married filing joint. So that's just another penalty to note. And then we also have the NIT tax, which is this other taxes section. It's automatically calculated. NIT tax, yes, thank you, Debbie. So you see the net tax here. Obviously, in this case, they're all high income, and this is the highest that it's going to be. But it kicks in for over $200,000 in income for single, and over $250,000 for married filing joint. So that's just another penalty, again, not doubled. So that's just another thing to note there. So now we'll show the divorcee situation. So let me clear this so it's easy for us to see. All right. So in this case, for a divorcee client, you can very easily show in the scenario analysis what the situation would be if it's the wife or the husband, whoever's client, if they went to being single, and what their situation would look like. Of course, in this case, say this is the husband and the wife with $325,000 in income. If you click in here, you can actually see the breakdown, which is nice, of whose is whose. So then here we're assuming Roxanne's filing single, $75,000 in income. And then, as Debbie mentioned, with TCJA, after 2018, alimony is not taxable, but you can input here if it's a pre-TCJA item, it will be taxable, and that's what you would input in this line item. So then you could calculate any taxes there. And also, just another note, some other items to think about are the child tax credit deductions and maybe some dependent care credit deductions that you could input here in the non-refundable tax credit section. So dependent care credit expenses, you could input that here. And then you could also see the child tax credit that you could get. So as we know, it's $2,000 per child that qualifies, and it will eventually phase out. So I just like to show you pretty quickly how it's calculated and affected if the income's higher. So just for reference, I'm just going to say she has higher income of 175,000 instead of 75,000. So we put that there, and then we scroll back to the bottom. You see that the child tax credit decreased to only 600. So that's just another nice feature that you see how everything's automatically calculated and the deductions are different. And then just so you see here, we just ran another scenario. We just change this back to 75 of head of household. As Debbie mentioned, there are benefits to that because you do get a higher deduction, not quite as high as married filing joint, but pretty much in the middle of single and married filing joint. So that's a nice plus there. And you could just easily compare the difference in taxes if they were head of household versus single. And as Debbie said, at the top here, it's a quick little toggle and you could do it so fast. So it's just nice to be able to see the difference. Taxes, see here. So you see total tax. If she was single with the same income, it's about 18,000. And then with head of household, just that, it went down to about 12,600. So it's pretty impactful and obviously very easy for us to run here. Yeah, so I think that's what I had for this.
Thank you.
Yeah.
Yeah. And some of this, when you have the knowledge and you have the numbers, sorry.
No.
Like knowledge is power. And then you can help the attorney and the client fight for what they would want, right? What makes sense. Okay, retirement. I'm going to move a little quickly through retirement and the other stages because I do want to get to some of the bonus material about the IRS guidance from July. And so here's retirement. We know that not all income is treated the same, particularly coming out of those retirement accounts, right? And so that's something, you know, when you're doing retirement planning or accumulation planning for clients, you always want to think of the end in mind. And so when you think of the end in mind and what the distributions are going to look like at the back end, that should essentially inform what you're doing on the front end, where you're directing the money to. And so anyway, so something to think about, and that's, you know, again, can be modeled. Here is, again, from FP Pathfinder, they have some nice flow charts for these different, you know, again, milestones. And so I decided to include this one here. And then the widowed client. So this is our specialty, is dealing with widowed clients. And so we do quite a bit of work in this area. And so a few things to think about is, again, the filing status. And so then the chat inevitably blows up. I don't have to go single, right? I can go like surviving, qualifying surviving spouse is what they call it. For me, it was always qualifying widower, okay, for years. Now they call it qualifying surviving spouse, basically the same thing. The problem is, again, there are hurdles that you have to jump through, and most widowers are not going to, satisfy it. And so what are those two hurdles is, or four hurdles is, first of all, you can be a qualifying widower for 2 years, but you have to satisfy 4 requirements. First of all, you qualified for married filing joint with your spouse for the year he or she died. I'll assume it's a he, okay? You did not remarry, that's number 2. You have a child, stepchild, or adopted child that you claim as your tax dependent, okay? Doesn't apply to a foster child. And 4, you paid more than half of maintaining your home, and it's gotta be the main home of the dependent child for the entire year, okay? So more or less, when you boil this all down, you can't remarry, you better have been married filing joint the previous year, and you need a qualifying dependent child in that home. Well, most folks that are widowed, most of the time, are in their 60s, 70s, 80s, so they're not going to have a qualifying dependent child. Now, yes, every once in a while, somebody is widowed at a very young age, and that is who would essentially qualify for this. And remember, it's only 2 years. It is a highly favored tax filing status. There's no question. So yes, we want to qualify for this if we can. But, you know, everyone just right away, when you say someone's widowed, everyone's like, oh, yeah, we get the widow status. I'm like, no, it's not that easy. So that's the rule here. What's the challenge is that widow's penalty. You've heard us talk about this so many times. And this is a real clincher when I'm meeting with prospects, is they have no idea that the widow's penalty exists. And what is the widow penalty? Going from married filing joint to single, right? Married filing joint to single. And this is something that even the do-it-yourselfers, even the retired engineers, they have not modeled this out. And so anyway, this is something we show them, and Jen will quickly demo this in a couple minutes. Okay, TFG, our widow checklist, right? And so here's the checklist that we created for when widows come to us. What are some of the critical things to think about is the IRA decision. You literally now at this point, courtesy of Secure Act 2.0, you literally have like 5 or 6 options as to what to do with that IRA. And so there really needs to be a lot of thought involved and coordination with the other accounts. taking that final RMD, filing that estate return and electing portability, and then notifying Social Security. And by the way, on the Social Security front, they have engaged in some unethical behavior. You can look it up. They have been investigated. I think it was from the Department of Justice or whatever the government agency is. And they were forced to repay widows because they were making recommendations to widows that I consider to be highly unethical. Okay. And that is how I felt. I saw those recommendations coming back from Social Security. We were mourning our widowed clients, and they did it literally just a couple months ago with one of my best friends who happens to be widowed and happens to be a client. And it was a very heavy pressure situation where they were trying to get her right on the spot to take retroactive benefits, which would have forced her to lock in a lower benefit now. And we did the calculation, and I said to my dear friend, we'll call her Julie, I said, if you don't think you're going to live past a certain age, and it was like 75 or 76 or something, or 80, it was not a big age to have that crossover. I said, then fine, Social Security's recommendation makes sense. If you think you're going to live past this age, then there's no way you should be doing what they're telling you to do. So make sure for your widowed clients that you are all over this. Okay, Jen, I want like 1 or 2 minutes on this because I do want us to get to the IRS guidance.
Yes, so I'm going to focus on the retirement to widow, as Debbie said, because it's really impactful and just shows how holistic plan can really show the difference there, which people don't really seem to believe until they see the numbers and how it can really impact them. So let me pull up the retired couple and then the widow here. So of course, retired couple, we're assuming the RMDs of 200,000 here based off the husband's age, Social Security, of course, both of them collecting, pretty much minimum other income besides that. And then just to look quickly here and compare, for the widow, of course, the RMD is going to be slightly less because she's younger, and based off of that balance, it's just reduced. And then we're assuming she collects on his higher benefit amount, so that reduces Social Security slightly there. Everything else pretty much the same. And then if you go down here, let me take this. I had the large medical expense here, but let me take that out just for purposes of comparison. So of course, the standard deduction is double here for the married, and then we're back to single for the widow. You see taxable income here comparison, and here's the really big thing. So just from married to single, they went from the 24% tax bracket to the 32% tax bracket, with, you know, and of course it's very similar income to what they had, even less, and less, yeah, and less income. And now she's single, and that's the huge penalty. And another big item is the IRMA surcharge. So you'll see here, with the couple, they weren't even in the highest IRMA surcharge bracket, and now she's automatically pushed into that highest IRMA surcharge bracket. Monthly, exactly. So those are really the key points here. I don't know if you wanted to show anything else.
No, this really hits the nail on the head. And this is why when your widows come to you in the year that they became widowed, you want to get to work on those Roth conversions. And I know there's all this guidance, don't do anything for the first year, blah, blah, blah. That is bad guidance. If they have a trusted financial advisor, you need to roll up your sleeves and you need to get to work, because you want to do those Roth conversions and accelerate any other income into that year of married filing joint. Because if you just wait that 1 month or that 3 months or whatever it is, new calendar year, she's filing single and she's got a problem. And so you're going to have to address it, even if it can feel a little touchy. And the widows appreciate it, right? They appreciate that you've got their back and you're doing the right thing. So good. Okay. Inheritance, key thing here. And we just talked about this a little bit, right? Is you've got the widow, and we've got the widow's penalty. From the very beginning, you need to plan around the widow's penalty, right? So I'm not even talking about waiting. I'm saying when you have a married couple coming to you and they're in their 40s, they're in their 50s, they're in their 60s, you have got to be thinking about the widow's penalty, because that is Ghost of Christmas Future, right? That's what their income is going to look like. And great tax planning is paying taxes at your lowest rate. What you just saw there is that the tax rate is literally 8% higher that's with us driving down some of the income. Typically, you see the tax rate for the widow at 8 to 10% higher. So if you look at that, she was in like what, 32% tax bracket. There's a good chance that when they were married, they weren't even in that tax bracket. So you want to start then pulling the income forward, doing that advanced tax planning, which we do with our clients. And again, if it's something you're interested in, comment in the chat, and Laura will say, hey, Debbie, a lot of folks interested in this. But it is just looking at lifetime taxes and then paying taxes at your lowest possible rate. And if lifetime taxes, if future taxes look like they could be higher because of that widow's penalty, then you need to be pulling some of that income forward and paying taxes now at your lower rate, right? And Holistic Plan is a critical part of that calculation, but there's other analysis that does go into it. All right. Inherited IRA flow chart. Remember, again, you have 6 or 7 options when you're the widow. So you want to be able to leverage that, be super thoughtful. All right, in our last 10 minutes or so, let's hop in to the new IRS guidance. Came out July 18th. Are you aware? I'm going to tell you, yes, I've answered that poll for all of us. Okay, so there's 5 aspects to this new IRS guidance. And I wrote an article on this, like literally 2 or 3 days after it came out. And so here, this is really the key items from the article. And so just as a reminder, right? So remember, this applies to non-eligible beneficiaries. This does not apply to the spouse, okay? Does not apply to the spouse, okay? So if you remember, right, coming into this, we have to deplete within 10 years. We all know that rule. By the way, 10 years is really like 11 years. You understand that part, right? Because you get part of that initial year. So it's really sort of like 11 years. But anyway, okay. So, but the confusion was around the RMDs, right? We knew in my office, we knew that IRS was coming out with this guidance, right? The writing was on the wall. But we were waiting for them to get their act together. It took them years to do this, right? Okay, so now we're into block 2 here, right? So let's just see, boom, boom. Okay, so over here. So RMDs are required for non-spouse beneficiaries, right? So that's like the headline, right? Is annual RMDs are now mandatory starting in 2025, not 2024, right? But 2025, if the deceased was already taking RMDs at the time of their death. So that's absolutely critical. And here's how you want to think about it. If the spigot was turned on, then it's got to stay on, right? Spigot was on, those RMDs have to stay on. RMDs are being taken, RMDs have to continue, okay? On top of that, the account still needs to be drawn down by the end of the 10th year. So you basically have 2 layers of things that you need to deal with, okay? Also remember though, it has to be an IRA that was left to a non-eligible beneficiary after 2019, right? Courtesy of Secure Act, right? Starting in 2020. So I know there's like a whole list of things here that have to be triggered, but you know, all of them are important, okay? So we've got to understand the new guidance, work closely with the clients. All right, so moving through then, obviously folks, delayed beneficiaries due to this lack of clarity. IRS has still excused the non-RMDs, if you didn't take RMDs for 2021, 2024, right? So that's fine, that's behind us, obviously no issues there, okay? The RMDs have to begin in 2025 without resetting the 10-year window, right? So here's a little handy dandy chart. RMDs start in 2025, but if the year of inheritance is 2020, that's really the first year that this mattered, right? Because of the Secure Act. The first year this matters is 2020. Then your full distribution deadline is 2030. Your RMDs are starting next year. So here's a little handy dandy chart. Now, what I said to my husband who works with us, and I was talking to him about this, is the first year we had like, 3 inherited IRAs, right, where this applied to. Because remember, we had inherited IRAs before that, but the stretch still applied. So 2020, we had like 3, 5, I don't know, right? Then 2021, it was a few more. And now we actually have a little bit of a list, okay? So my point to you is you may not have created processes around this because you only have like a few people that apply to. You didn't have the whole RMD thing. You had 10 years. But what I'm telling you is you need to start building process around this because every year there's going to be more and more people that are going to fall into this bucket. And by the way, the software, not Holistic Plan is great, but other software doesn't do a great job of addressing these rules. First of all, the R&D part, well, that's brand new. Even the 10-year part. So a lot of this is falling on you, okay? All right. So we covered this. And remember that this applies to inherited IRAs only. It does not apply, to your own IRA, your personal IRA or whatever. Okay. And oh, by the way, doesn't apply to Roths. So this comes up. Remember, there are no RMDs on a Roth. So yes, the 10-year rule applies to the Roth, right? Basically pull the account out at the end of the 10th year, or, when you think it's hit a peak, maybe that's at the 9.5 years, whatever. But there are no RMDs. So this does not apply to Roth, inherited Roth IRAs. Another reason why we love Roths, right? Another reason. Okay. Not applicable to spouses, right? So spouses can still choose from one of 5 or 6 or 7, depending on how you define it. They can opt for continued distributions, roll it over. You can step into the deceased spouse's shoes. You can disclaim, right? So the deceased spouse still has a lot of options. This applies to the non-spouse beneficiaries who inherited an IRA in 2020 or later, right? So you've got it. And remember, the IRA had RMDs already coming out of it, right? So it's got to be like, it applies to this and this and this and this, right? Okay. So regulations apply to non-spouse beneficiaries when the deceased was over 73. So we've got that. Okay. Some parting thoughts on this then. The RMDs must be taken if the RMDs already started, right? And you inherited the IRA after 2020 or later, right? And you're not a spouse, okay? Remember that missed RMDs are subject to a 25% penalty. So they did change that. And large intact balances after 10 years can result in significant tax hits, which brings us to our last point, which is post-mortem planning is what we call it. And so we have 1 or 2 slides here. You guys have been amazing. Everyone's hanging in there. So post-mortem tax planning then is more important than ever. And so we wanted to just show you, we have created an entire spreadsheet around how to be managing the post-mortem. And you see here then, we've got the client, it's a Benny IRA, who the decedent is, the balance is, the date of birth, because that's important, when they died, because that will, of course, trigger the 10-year, right? The beneficiary date of birth, this is how you calculate the RMD, is based on the beneficiary's date of birth. And then what the RMD is, and getting the balance to 0 when that has to be. And every year we are then doing analysis for these larger balances. And so yes, if somebody has a $16,000 balance, no, we're not too worried about that. But you see this, that's not a typo. That is a $4.7 million Benny IRA balance. This we are doing analysis on every year to figure out how to continue to draw down this balance and do it in the optimal way. And just a little pro tip here real quick is this situation, they were a dedicated couple together for 25 years. He never married her, nor did they file for like that little certificate at the town hall that also would have qualified. And so they were hit with an inheritance tax from the state of New Jersey of $1.5 million because they did not have a financial advisor, and there was they did not do their homework, and the state, right, the state of New Jersey had an inheritance tax on them. Okay, so this is just another reason why people need us. And so with that, then bonus material, we sent this out just a couple weeks ago. This is our IRA reminder that we send out during the summer. And with that reminder is those of you who know people, or if you're not signed up yet, here is a 10% discount code, Debbie Taylor 2024. And with that, then, Laura, back to you.
Amazing, amazing, amazing. So informative, so helpful, so inspirational even. Debbie, Jen, thank you so much for this. This was really fantastic. As you can see, the Q&A was absolutely popping off. We have over 60 questions. So we will get you the Q&A after the webinar. Debbie, as you know, she likes to go through them and answer them. So we will send out some answers in a recap email. We'll send the recording. We'll send the slides. We'll send any kind of handouts and bonus material that was in there. So it's basically a treasure trove. So keep an eye out for that recap email. And thank you so much for joining us. Make sure you hop on the next webinar we have. And We'll see you soon. Have a great rest of your day.
Thanks, folks.